Welcome to the Stock Play of the Day. Today we're going to talk about gold. Specifically, we're going to talk about the ETF in gold, GLD. We'll discuss, should we pass or should we play? Hello everyone, my name is Brian Overby. I am the Senior Options Analyst with Ally Invest.
And I'm Lindsey Bell, Chief Investment Strategist with Ally Invest. Thanks for joining us today.
Hello Lindsey. Well, I have a chart of the S&P 500 index up. What are you seeing in the markets today?
Thanks, Brian. Well, before I get into what's happening in the markets today, and there's some exciting stuff happening, I just want to make sure our viewers know that we're going to answer your questions at the very end of the show. So in about 30 minutes, there's a box on the right-hand side of your screen. Be sure to type in there anything you have on your mind that you want Brian or I to answer, and we will get to it, like I said, at the end. But back to the markets. Today, we're seeing a lot of green after what was a very, it was a pretty bad week last week. There was a lot of red. There were some big down days. We're getting a bounce back today after we got into what was a really oversold territory last week. This morning, over the weekend, we got some really negative manufacturing data out of China. That was expected. It was a little bit worse than expected. There was news of the spread of the coronavirus. 2 deaths here in the U.S., the first case in New York City. There is that expectation that we're going to see a continued spread here in the U.S. In the near term. But markets, they're feeling good because we've got central banks around the world signaling that they are going to be able to step in and do whatever they need to do to make sure that we don't go into a recession or that they've got really the markets back. We've heard from the Bank of Japan this morning, the Bank of England talking about it, and Friday, Fed Chair Jerome Powell really led the messaging of that with his message to investors on Friday that he would do what it takes. Now, they don't meet until not next week, but the week after. But there also is a meeting later this week that we just found out about with the G7. So these large countries are going to get together to potentially coordinate action, whether it's fiscal or monetary, to really support markets. So that's why you see the upbeat mood in the market today compared to what we saw last week. I know you got a chart up there, Brian. The SPX moved into correction territory last week. All the major industries were down double digits. So it was a bloodbath across the board. The Dow Jones had the worst week, down more than 12%, the worst decline for that index since the financial crisis. But, it was small caps, it was mid caps, it was growth, it was value. Everything was down. All 11 sectors in the S&P 500 were in the red last week. So it was really panic on, risk off, selling mode in the markets, and you really just couldn't get out of it, which is why we want to talk about gold. We want to get into that. The other thing, Brian, that we saw in the markets last week was this huge jump in the VIX. Actually, by Friday, the VIX almost touched 49. But today, again, we're seeing a pullback in that that's coinciding with the bounce that we're getting in the market too. So what does that mean? I think the last I saw, the VIX was at about 33. So that's a pretty big move down from almost 49 at the end of last week, just the last trading day.
Yes, technically, there are a couple of interesting things that happen when you compare the VIX index to what happened in the S&P 500 index. There are 2 crucial points that we saw. Right now, we're looking at we're looking at a chart of the VIX that goes all the way back to prior to 2007. Now, some real interesting points. I've drawn a trend line, or I guess a segment across the 50-point level in the VIX, which we almost saw it touch. It did get up to 49. It didn't quite get to 50. But if you notice how many times that the VIX index has got up to 50, that it usually has a tendency to pull back. Now, we have one extreme exception to that, and the market always wants to say whenever you're feeling confident about something, it just wants to let you know that the market's in control, you're not. And we saw that back in at the end of 2008. We did see that a very volatile marketplace did get more volatile, and we saw kind of an all-time record high in the VIX index since they recalculated it all the way up to the 90% level. So it doesn't mean anything on its own that it got up to that 50% level. But you throw in the fact that we saw the market get up to this 50% level in the VIX index. We've seen that it's touched 1, 2, almost 3, 4, 5 times, going all the way back to 2009. And every time it's came close to that level, we've seen the market come back down. Now, if the VIX is going down, that usually means that the S&P 500 index is going up. So whenever we see that situation going on, usually means that a lot of the sellers are coming out of the marketplace. A lot of the fear factor is starting to come out. And now I'm going to jump back to the S&P 500 chart, and I'm going to highlight this. Actually, let me zoom out a little bit just so we can see the line a little bit better. But that October 2nd low that we hit, or that started the rally, ever since October 2nd, the market came down. Well, October 3rd, the market on that day on the low was 2,855 in the SPX. If I look at my chart, on my Ally Invest chart here, and then from that point on, it basically was nonstop rally, and we gave all that back, a 100% retracement all the way down to that level. And it's just interesting to see that the SPX basically just bounced off of that level. So now you're getting a few data points to kind of hint that there might be a rally going into the market. And then, not to mention the fact that as the market closed on Friday, the last 5 minutes of the market were just crazy. A lot of buyers came in and drove the S&P 500 index up about 20 points in the last 5 minutes. So we have a few data points that were kind of hinting that we might open up. But then again, it's a weekend. You get some news. As you mentioned, coronavirus, there's a few more cases that come in. So you never quite know exactly what was playing out. But I like to look at the VIX as, well, this is just one data point that makes me think, well, maybe we're getting some consolidation in the marketplace. Some of the sellers are starting to come out. We're starting to maybe get some buyers. And then you throw in the fact that you see a big point like where the rally took off back on October 3rd. And then you just start to feel a little bit more confident in the marketplace overall. All right. With all that said, I still think gold is in play. And I'm going to put up a chart here on the GLD, or the gold ETF. And I'm going to pass it back to you, Lindsey. What are we seeing in gold? What are your thoughts?
Yeah, sure. I might just add, though, before I get into gold, just add to some of the commentary that you made too at the end of last week. You were talking about some of the signals, the VIX getting really elevated, and then you saw this morning the bounce off of that October low. Also, we saw sectors like the semiconductors that got really beat up when news of the coronavirus spreading took off, and because they have such a significant exposure to China, and we knew the manufacturing data from the month of February was going to be really bad. We saw them bounce last week. We also saw energy stocks, which got really beaten up last week. They kind of bounced at the end of the day on Friday as well, too. So, we saw some of these different things really kind of creating a storm where it felt like the market was in this position that it would be ready to rally today. Now, we don't know if this rally is going to stick. You oftentimes do see when the market pulls back as sharply, as quickly as it did, a bounce after that, and we could still move lower because we are going to get pretty negative economic data in relation to this coronavirus outbreak and the supply chain shutdowns. The question remains, where is demand in this process? The good news is, though, is we're going to hear from a ton of retailers this week. So we'll get a good sense of where the consumer is right now as this is just starting to spread here in the U.S. We saw last week the personal income data was really solid. Spending wasn't as strong as expected. I think consumers are starting to be a little bit cautious, but incomes are up. That's certainly a positive. And we get the jobs number on Friday. While market participants might not read too much into it because they're going to say, hey, that was in the past. That was the month of February. When coronavirus really wasn't a big issue for the U.S. Let's see what happens to jobless claims over the next several weeks. Let's see what the job report in March looks like. So you might see us looking through that. But right here, it does make sense and it feels right to have a little bit of a bounce. We just want to caution our viewers that we're not sure that this bounce is going to stick around forever. There is risk to more downside from here, especially as earnings estimates get hit. But we're encouraged to see that the market is working the way it should. Because at the end of last week, it was starting to feel a little uneasy with the amount of selling that was going on. So let's dig into gold, because that actually, Brian, is another area where we saw selling last week, which is not intuitive. Usually, gold is the safe haven. That's where you're supposed to go in this type of market period where there's market uncertainty, where you expect economic data to slow significantly. When you see and expect, and you're hearing news from central banks around the world that there might be a coordinated effort, more a dovish tone from central banks, more stimulus in the economy with the dollar declining. Usually you see gold bounce and do pretty well in that type of environment, at least better than any other asset class. That has been the history of gold. But last week what we saw is the yellow gold, the yellow metal, excuse me, it peaked on Monday. And then from there, we saw a 5 percentage point pullback into Friday, which, got us scratching our heads a little bit. And that's why Brian and I decided to take a look at it today. Could there be an opportunity here? Because just as a reminder to put things into perspective, you can see it there on the chart. Gold ran up over 30% from May of last year into Monday of last week. That's a huge move, especially for gold, okay? So that 5% pullback doesn't sound like a lot after you've had that big of a run. But again, it was a little bit confusing given the market dynamics. And what we found out is really that there was a panic selling situation going on in the market. So you saw investors selling their gold too in the midst of that panic. Also, there are some gold newsletters out there talking about how a lot of people were some investors were selling their gold to cover margin calls because of the sharp drop in the market. They were getting calls to cover for their margin. So you got that. You have people thinking about, hey, China and India, they're the two biggest consumers of this product of gold, and they're not really meeting in the marketplaces to exchange hands of physical gold, jewelry, and whatnot, bullion. So those transactions are on the decline, but so I think it just put some pressure on the metal last week. But you have to remember that the underlying, given the environment that we're in, central bank easing, the dollar weakening, potential inflation increasing, these are all things that help drive gold higher. So, we wanted to take a look at this, given the pullback. We thought there might be an opportunity. And Brian, I know you're looking at a pretty interesting options trade, aren't you?
Oh, yeah. So let's get into the option chains here at Ally Invest. So now I have the option chain up. We see that gold has actually made a little bounce off of the Friday lows. And just like the market, we see gold right now is up about a 1.5 on the percentage wise. It's up $2.21 actually. So yeah, with gold in this situation, a lot of people will think of it as a safety play. And the fact that we saw some selling actually bring on more selling, you're right. It made sense to me when you talked about maybe some margin calls, or even if I have I'm doing fairly well in my portfolio and I want to generate some cash. I want to get some cash so that if I do think this downturn is just a short-term, let's call it a V-shape, if I'm expecting a V-shaped recovery, I might want to just generate some cash. And why not do the one thing that I'm up the most on? If you look back, as Lindsey mentioned, going all the way back to May, that would be gold. So I think there was a lot of that just happened. And the selling just brought on more selling. Okay, so we got the bounce back. Now, one of the things that is important to note on gold is that I was looking at just doing a long call today, but I just saw elevated volatilities in gold. And gold a lot of times will trade at just because it is a metal, because it's more like a commodity scenario trades with not a ton of implied volatility overall on the option contracts. We saw that big spike up to about 20% implied volatility in the GLD vol in general. So because of that, I decided that I'm going to do a long call spread. I think I want to sell some volatility premium. The average for gold is right around 12% implied volatility on a 30-day basis. If we just look at that, it's right around 12%. So with that said, I'm going to look at a long call spread or a bull call spread in gold. That means I'm going to be buying one option contract, and in this instance, we're going to go a little bit in the money, and then we're going to be selling an out of the money option contract to help pay for that in the money option. So we're going to try to reduce our overall risk by selling an option contract with the target price out of the money. In other words, we're going to look at where do we think gold might be able to land over the next couple of weeks, and that's going to be our target price. So if we go back to the Ally Invest chains here, we see on the left-hand side, we see the calls. On the right-hand side, we see the puts. The paper trade for this week is going to be buying the 148 strike call and then selling the 155 strike call. So we're talking about a 5% move. Gives us a lot of upside if gold could make that type of move over the next couple of weeks. The expiration is 18 days away. When I'm looking at doing a long call spread as opposed to just a long option contract, they max out closer to the expiration date. So if we're right on our forecast and the underlying market goes up to the 155 level, then we'd want that to happen closer to the actual expiration date, as opposed to if we bought a long call, we'd like it to happen right away. We'd like that move to happen. So if I'm just thinking about long calls, I'm going to err to the side of buying too much time. If I'm looking at a long call spread, I want to try to get my forecast a little better with the long call spread, because I'm buying one option contract that wants the market to go up, but I'm selling an option contract that wants the market to stay neutral or go down. So they kind of fight each other a little bit. So what's the moral to the story? Long call spreads have a tendency to max out closer to the expiration date if you are correct on your forecast. Okay, so a long call spread, March 20th expiration, which is the normal monthly expiration, that's 18 days away. And if we scroll down to our strategy workbench here, we see that it's a 7-point wide spread. That means that this thing could trade for as much as $7. We're going to be paying $2.83 if we can fill at the midpoint, right? If we can fill at the midpoint, it's $2.86. That will be our max risk. If we had just bought this call outright, our max risk, if we look at the asking price of that option contract, would be $4.10. So we're reducing the overall risk of this trade. If you just think about buying one contract versus doing one spread, a one-by-one spread, and we're paying $2.87. That's $287 plus commission. I always want to think about commissions, but that's also my max downside on the trade. The width of the spread is 7 points here. You take 7 minus, we'll call it $3. That means that your max upside is going to be around $4 on this trade, $4.17 if you want to be more exact, if we could get a midpoint fill. And we looked at the profit and loss graph actually inside the options playbook for a long call spread. If we look at it here on the Ally Invest profit and loss calculator, you see, okay, this is where the stock is at currently, that line right in the middle of the chart. The strike that we're buying is the 148 strike. That's where our losses stop. If we are incorrect on the forecast and the market goes down, that's the maximum we can lose on that trade, and we'll see that that's the price that we would pay. So in our instance, we're hoping to get filled at around 280, so that'd be $2.80 or $280. On the upside, we see 155 is our target. We hope that we get, that'd be about a 10% move in a couple of weeks. That would be pretty good. It's okay if it doesn't quite get there, but we're okay with that. But to start with, we see the colored line is the profit and loss graph as of today. And now I'm going to go fast forward to expiration. And now we get the benefit of seeing now the profit and loss graph, the green or the colored line is very similar to the actual expiration graph. And that's part of the reason why we've got to be a little bit more particular when we're picking an expiration on a long call spread. All right, so the official paper trade for this week for the stock play of the day, the option paper trade, is we're going to look at buying the 148 strike call and then selling the 155 strike call. Same expiration, March 20th, approximately 18 days away. We're hoping to fill somewhere close to the midpoint, which would be about $2.80. And then that makes our maximum upside that this thing could trade for is $7 minus that $2.80, which would be $4.20. I like the good risk reward here, what we're paying versus what we could get on the upside on this trade. And I guess that's going to be it for the paper trade for this week. Let's get into some of your listener questions here. And I just want to remind you that if you do have some questions, Lindsey and I are willing to take a few here. All you got to do is just toss them into that chat box and we will address them. All right, so I got a fun username here, Lindsey. I'm going to give this one to me to start with. Put Strike 1017 says, Brian, you mentioned an increase vols in GLD. Why didn't you consider just selling a bull put spread? Well, that's actually not a bad trade to think about. If I'm selling a bull put spread, I'm going to be a little bit more neutral to bullish on the marketplace. So by doing that trade, that's a definitely doable, and we got a fairly expensive underlying. It's trading at $150. You have increased volatility, so there are a lot of things that might lead you that way. But here we're just being a little bit more bullish on gold because of the big downturn. So if I'm going to be a little bit more bullish, I'm going to use calls, and I'm going to do the long call spread or the bull call spread. If I was going to be a little bit neutral to bullish, then would be a time that I would look at doing the bull put spread or the short put spread and bringing in a net credit to the account. All right, do we have any more questions? Let's see what we got. All right, Trader 978, Lindsey, this one's for you, obviously, called you out. What are your thoughts on the deep decline in the energy sector? Is this a buying opportunity?
That's a good question. I mean, the energy sector has really been beaten up. Just this last week, it was down 15%. It's down pretty big for the year. This is a sector that's struggled for a long time. And with the sharp decline in oil prices, I think it was down about like 26% year to date. So, it's hard with oil prices that low to get bullish about energy. I know Exxon, Chevron, they're both offering pretty sweet dividend yields at this point in time. I think around 5% or more last I checked. I want to see oil prices stabilize to start moving higher before I want to get bullish about the energy sector. You got OPEC meeting later this week. There are expected to be some production cuts there. But I think just because earnings for the energy sector are so highly correlated to oil prices, I think it's still a little bit difficult to be in this group. Also, this is a sector that is now less than 5% of the S&P 500 index overall. It's about 3.5%, which is a pretty small representation. And so it's just become a less important sector for bigger institutional investors to hold. So there's not, to me, I just don't see a lot of support until oil prices go higher.
All right. We actually got a few more questions that have popped up here.
Okay.
All right. So Ron is actually saying, and I'll just go with Ron here. He's got his last name in, but we'll just go with Ron. Why not an iron condor and wider? In other words, when we mean, I'm assuming, Ron, that when you say wider, go wider out in the strikes that we're selling. I do not mind the iron condor. It's actually very similar to what Put Strike was mentioning. Why not just look at selling a short put spread or a bull put spread? And it's the same concept in that if you got increased volatility, why not sell something and bring in a net credit as opposed to paying a debit? An iron condor would be very similar to that. We're going to be selling the short put spread, hoping that the market goes up, and then we'd be selling the short call spread, hoping that the market goes down. So what you're looking more so for in gold would be a neutral. You really want the market to just stay where it's at. And so if I were looking at this, I think the market's just too volatile to be doing both sides. In other words, if the market goes way up or the market goes way down, I'd be a little bit more nervous on an iron condor. I actually like what Put Strike was mentioning a little better by just being a little bit bullish, considering we had the big downturn last week and then all of a sudden the big bounce up. Let's just follow the trend, sell the short put spread, and I'd stay away from the iron condor from looking at it. All right, and then I guess we got another question. This one's actually for you again, Lindsey. All right, Boozy Gamer. All right, gold dropping last week. I didn't understand. Thank you, Lindsey. And actually, that what you said makes sense. Could you see an extreme drop in the market when the store shelves are empty? Or do you think we have extra? All right, we'll leave it there. What, do you see a drop in the market when the store shelves are empty? Do you think that could happen?
Look, I mean, the last thing we want to see is a panic here in the United States regarding the spread of coronavirus. But I do think that people are starting to think about, I better make sure that my shelves at home are stocked up with food in case there is some sort of quarantine that does happen. I do think in that type of scenario, if there are quarantines, we could see a deeper drop in the stock market because that's certainly going to put fear into people. It'll bring back that feel for panic and the need to probably sell or at least feel like you need to sell at that point. So yeah, for sure. I mean, the OECD came out today. They cut their global growth estimates for the year to 2.4%, which is the worst since the 2008 recession, 2009, the Great Recession. And that was their best case scenario too. They think that if this thing gets much worse, it could be the global growth target could be as low as 1.4%. Anything below 3% is pretty dire situation. So we're hoping for the best here. We hope that we can see some containment in the U.S. And that, along with either fiscal stimulus or monetary policy, will help stabilize the markets.
All right. Well, no more questions, and we're running out of time here a little bit. We've been a little long-winded today, but let's summarize. Lindsey, back to you. What about the markets?
So the market's bouncing back today after a brutal week last week. We've seen five corrections in this bull market so far. It takes about 5 months for us to get back to break even after a correction. We don't know if the worst is over yet, but we're encouraged that we are seeing a rebound today after a really tough week last week.
All right, and the next one we have, I'll jump in here on the stock play of the day. Well, as Lindsey mentioned, we had a couple of big things that happened last week. The VIX index getting up close to 50. We hitting that support level of the October 3rd low before we had the big run up in the marketplace. Those were two significant events. Doesn't necessarily mean that no major news was going to come out over the weekend and drive it, but technically by looking at the charts and looking at these couple of things, kind of hinted a little bit at a rally. Gold is a flight to safety. We had a big downturn in it. A lot of people didn't quite understand it last week. So we're just going to do a short-term play based off of that fact that we had that downturn, and then maybe that selling was a little bit oversold. And maybe we'll get a little bit of a bounce back in the gold. All right, option strategy, went into a lot of detail on it. Being a little bit more bullish, even though we had volatile marketplace, we leaned towards the long call spread as opposed to a short put spread or an iron condor overall. And that's just saying that, yeah, I do think we got a little bit more upside. And it's actually fairly aggressive if we look at it going to the 55 strike. But why else did we sell the 55 strike? Because there was some premium there. Because there was some volatility, so why not? We brought in on the 55 strike, if I actually look down at my computer, I'm bringing over $1 on that strike, $1.14 to be exact. So why not? And that's the outlook as far as the paper trade for this week. And I guess that's going to be it for this edition of the Stock Play of the Day. So I want to remind you, make sure you click subscribe and you ring the bell, and we'll be back at the same time, same place next week. Thanks for coming.
See you next Monday.